Hi, everyone. How's everyone doing today? Hope you had a good holiday or a nice day off. Hello, Shahab. So, holiday shortened week. We have Michael at Mystery Trader. Hi, Brock, Kevin, Itai, and Kastu, Braj, everyone. Tian, good to see everybody. Everyone ready to rock? So, I want to start off with the Dixie, Kevin. Pretty significant support here. We're getting lower highs. Been talking about the short side of the dollar from here and then here. Went home short a piece. I booked it. Probably regret it, but you look at this level right here, and next support is down here at 98.40. So could be we're getting ready to resolve this rectangle and resolve it to the downside. Of course, we need this close under 98.28. It's going to measure back down to here at least 96 and a half anyway. So dollar looking weak. The only thing is pounds leading it. Grega preferred the long and cable over euro when he was here Friday. Fade Greg at your own peril. And the euro held right where it had to. Where everyone wanted to buy it when we were up here was right around 8.5, and the low was 870, close enough for government work. And if we start penetrating this 110 level, it's a pretty easy target. See, 110, we didn't take it out. So this is kind of an ascending triangle that's going to measure up towards about 112.50 up here. And actually, the 200-day stopped the market Friday before we got this pullback and went right to the 50-day. You're going to see a lot of different instruments that are trapped between the 50 and the 200. So things are compressing. Looks like path of least resistance is still to the downside. Been upside, downside for dollar, upside for euro. With the pound outperforming, you're getting this pretty nice pullback. I'm not sure if this was it. If you recall, we all kind of liked it here, EG at 87. I actually forgot what Grega was saying here. Was this it, or do we have a pullback and another push up? Didn't get to 61.8 or even halfway back of this. Euro Swiss holding up much better than Euro Pound. Okay, so still think there's a shot for mid 107. You're not going to want to be long under, say, 105.40 ish. Okay, thanks for the news fundamentals. FX Trader. Something, of course, everyone has been looking for S&Ps to get to the 200-day, and we're trading through it by a bit. So we'll see what happens here. I'm looking for a top this week or early June. I tell you what, even though the technical said that we could rally to 3,100 because this was a gap, and here's your megaphone line. Comes on in here as 30.95. Not sure if we're going to stretch all the way up here before we fail, but not a lot of divergence on the short. You can see short time frames we're confirming up here. Well, one thing I can say that I know, anything that's going on here, we had this stop hunt. I wrote about it on Twitter. It looks to be more than a stop hunt. I guess you could call it a breakout over this 29.77 level. And you have some moving averages moving up to the same level. So I would say that if you don't like to hear the ice crack and trying to get an edge on some type of high in the S&Ps, you could probably just wait for this to turn into a breakout failure. And that's going to happen down here at 29.80. And the last thing I'm looking at that hasn't quite been perfect to fulfill the formation is the oil. Finally, if you look at the oil, we have a 1, we have a 2, and we have didn't quite make a new high here. We missed this high by about 10 points. So looking to play a 3 driver up here in the crude. I'll give it some time to see if it could take out the stops. The high so far has been 53 uh, here, and the high it needs to take out is 3464. So looking at this, so it's not a huge tell, but all the way up, crude has been recovering with S&Ps, and if you remember last spring, last winter, crude was really getting crushed before the S&Ps really gave up the ghost. So this beginning to lag is kind of a sign on that correlation. So I'm not looking for a collapse in the crude oil market, but I do think once we topped, pull back towards 24 uh, is viable. Could get some type of uh, $9 break in the crude. Just looking for a scalp there. See, was there anything else I wanted to cover? So yeah, oh yeah, this time it's not going to hold. It's breaking down. USD CAD tried to bounce one more time. We had this, I called it a hope low, and we rallied back to almost a descending triangle, cracking now. If I want to be constructive, then I'd go with this formation. And I think that's what Steve is talking about, maybe a pullback towards 136. If I want to be a bear and I'm just a pure classic technician, I just look at this 38 and a half, 46 and a half, 800 pips from here gives you 130. So definitely a heavy look in USD CAD descending triangle. Take a picture. It's right out of the Edwards and McGee textbook. And really, if we have a breakdown, it's really not late. You're finally getting a signal that you haven't had in USD CAD for almost this 2-month period of it ranging in here. So that's the look that I have, and want to encourage people to become a part of our trading family. And we have a couple, Blake, Gregus Long Cable here, and half size position for Blake in the peso. But you guys really want to try us out for $1, okay? Because you're going to have a hard time finding a better team. You ever hear the expression that what good is anything until it's shared with another? So that's what we're doing. We're sharing it. And maybe instead of you thinking about that you're paying us, we're sharing our work, you're sharing your money. That's what makes it a two-way street. One-way street is you try and get our work or as much as you can get for free. So Blake, did you have a barbecue yesterday?
I did,
Uh,
actually.
yeah. How was it? 99, 100? What was it?
Hold on
The
one
temp?
second. I've got to
Sure.
turn
Go
down
ahead,
the
buddy.
speakers to my office. Just give me one second.
Okay.
Dang it. Okay. Sorry about that.
That's okay, buddy.
It was a little warm, but it wasn't, it's not nothing out of the ordinary, really. How'd your Memorial Day go?
I watched that mini series, The Pacific,
Oh,
and
that is
and
a great series.
yeah, I like it even better than Band of Brothers, which was about the European campaign. But
You liked it better than Band of Brothers?
yeah,
Oh, not me. I
yeah,
Band of Brothers is
yeah,
my favorite, but
yeah. I mean, I love them both, but
yeah.
to me, it looks like you know, the Marines in the Pacific had it a lot. Look, they both had it tough, but what they went through, I'm in awe. every time I think about it. And I only had one thought that we can't give up on what they fought for,
Yeah.
and that we have to fight the good fight too, to hold on to the values that they gave their lives for.
Yeah. Yeah, for sure. For sure. Well, I hope everybody had
And
a
and
what?
make tips in the meantime.
Yeah, yeah. I hope everybody had a great long weekend. It was, as everybody can see, we're the S&P has just rallied substantially. We're
Yeah,
actually above the 200-day moving average. First time we've been up there since March. What is that? March 5th.
yeah.
So we're above the 200-day moving average. We continue to extend our gains. Can we continue higher? Yes, we can. We can absolutely. Now, am I betting on it? No, I'm not, but I'm just saying that it's possible. So, while we trade above like this 2960 or so, you have to
Yeah,
imagine this pink line right here. You have to imagine that
yeah.
we're in rally mode, and it's going to continue while we're above there.
About
Um,
2980 is where it took that level out.
yeah, right.
Yeah,
2980.
yeah,
Yes,
yeah.
the 29. What is the high right here? It'd be 29
78.
72. Yeah, so somewhere right around here is going to be like
Yeah.
the highs. And so while we're above there, you have to imagine the gains can continue. You look at relative strength, it has been divergent. We're trying to break a downtrend line. So, risk is very well bid right now. Um, there's a lot of positives in the market, but like between possible vaccines for COVID-19 and one of the big things that I think that the market's going to be looking at is going to be on Wednesday. And I know during the week ahead video we talked about Wednesday about the European Union and the fiscal union that well, it's not really a fiscal union, but the 27 EU members are going to be discussing possible response. And if you get a big agreement from the eurozone and the majority of them agreeing, this is where you could see the euro really take off. I mean, the euro is stronger right now, and obviously you look at the daily chart. This is a big rally, and I think the euro is extremely bullish here. Now, if you look at just a technical formation, let's just think about this for a second. Let's imagine we close somewhere around here in the euro dollar. Okay. We close somewhere around here. This right here is a morning star formation, with the big red candle, this, spinning top, and then a big white candle. This would be a very bullish chart that would point a lot higher in the euro dollar. I'm pretty hopeful that a post Wednesday, if it's some pretty good news and the market responds favorably, that the euro is going to be breaking out on Wednesday. It's it may make sense to have a little bit of exposure going into Wednesday, knowing that you might have to pull the plug on it. But the euro looks at risk of breaking out. We've been when you take a range like we've been in since the beginning of April, right? And you're like range bound, range bound, range bound, range bound. All of a sudden that we're marking 0.5% of that range. That's a setup for a breakout. All right. So that's not saying that we will break out, but it is a setup for a breakout. So I think that's the risk right now. And that's something that I think most of us need to be paying attention to, that we might get a breakout in the euro dollar as early as this week. I think a lot of people are short, euros and long dollars right now too. And so the risk of an accelerated move towards the 111 to 112 to 113, I think could happen. And I think we've got to all be prepared for the possibility of that. And that's why I think that the euro's got to be on your radar going into this week. Also, I've heard that at the end of this month, for end of month, we're going to have some dollar selling. So if you just want to talk about um, you know compounding on that move, That's entirely possible. But some big developments are happening. I mean, you look at the cable is ripping today, and that is a lot stronger than, I mean, you just look at the pound, it is just on fire right now. And I was like, wow. When I got up this morning and I saw the cable ripping what it was, I'm like, man, that's caught a lot of people off guard. Because I'm not short the pound dollar. I'm just, when I got up, I'm like, I mean, that was back after it's already ripped up, from this 120, the low 122s to the mid 123. So very strong move in the cable. The Aussie continues to break out. We talk about the Aussie, going to the 67 cent level, and the 200-day moving average is literally, I mean, we're 30 pips away from the 200-day moving average in the Aussie. The Aussie continues to just rip rip heads off. Kiwi as well. The Kiwi is above these range highs that we'd been, kind of bouncing around, and we're about ready to challenge the 62 cent level, which is the lows from, back here, September of last year. So, the Kiwi continues to make some. Matter of fact, I got to see where that is. Hold on. Let's see. High, low. We still have some room to get to the 78% retracement, but as you can see, continue to make gains there. The dollar Canadian, I mean, we're breaking the wedge support right now, actually. And so the dollar Canadian looks like it's in trouble. The dollar Mexican peso is testing. These are the levels that we haven't seen since January of 2017. This is the big breakout point. We're currently there basically right now. All right. So, and a 50% retracement. So it's going to be interesting to see if we can get some sort of bounce here. Yeah, I mean, there's just big moves developing all over the market, and we're seeing them just everywhere. The rand, I mean, look at the South African rand. I mean, that's today just continuing to get pummeled here. Well, I mean, the rand is strengthening. So the emerging market currencies, while they are stronger, like the rand, the peso, you have to imagine that risk appetite is going to stay strong when that's happening, right? And well, like I said, that's exactly what's happening at this moment. So just keep your keep your guard up, and don't get lax here, because the stock market still looks bullish. And like I said, we are above the 200-day moving average right now with the S&P. Let's take a look at this, just what this range extension would look like in the S&P. And I know you guys are like, oh, it's turnaround Tuesday. Try to get turnaround Tuesday out of your head. I mean, I know it's something that people like to talk about. And yes, today is Tuesday. And yes, the market could turn around today. Of course it can. But just keep in mind that it's not a given, and it's not something that you should always go, oh, it's turnaround Tuesday, so I'm going to sell. You know what I mean? That shouldn't be your attitude at all. But high to low, which actually comes in right here, you can see right there, takes us to 30.33, and we're at 30.11. So that's 127% extension. So you can really extend another 20 points, S&P points here, before we see any type of meaningful resistance. That is entirely possible. So just keep that in mind as we head into today. Let's see, anything. Oh, I did want to talk about the dollar yen. The dollar yen is absolutely getting wrecked today. Well, it's getting wrecked with the dollar itself. But big rejection in the dollar yen at the 38% retracement. I'm not trading the dollar yen right now, but I'll tell you, the dollar yen does not look good. It looks like we're going to roll over here, and push. Now that we're below this little trend line, while we're below 107.70, I think that's where you're going to be on the short side. I think if it bounces today towards 107.70, that's probably the level that you want to be on the short side if you can get it. But just keep an eye on the dollar yen because the dollar is weaker across the board. I personally, I'm looking at the euro, and I think this is worth, the risk of it possibly breaking out today, or this week. But what I'm not going to do is I'm not going to buy it here at the 109.70 level. I want to try to pick it up on maybe a dip towards 109.30, 109.40. That's what I'm going to be looking for today if I can find it. It's just seeing if we can get a dip down towards those levels, because I think that, like I said, the risk of the euro breaking higher, if it happens, you want to be involved at least a little bit, and that's why I want to have like a little piece of euro longs, and then if it does break out, then I'll feel more comfortable about trading it to the long side, or adding to it on the way up if I've got a decent position going into into Wednesday and it breaks out. So, but don't want to overextend myself either. So yeah. And what I'd like to do is, since we have European, I have a couple European partners, it's going to be interesting to get what their take is, especially, well, Stelios and Steve, what their take is on, this meeting that's happening and how they feel about the European Union as a whole. So good morning, Stelios.
Good morning. Hi, everybody.
How you doing? Good morning, Steve.
Good morning.
So what do you guys think about this big European Union meeting on Wednesday, and what do you think can happen here with the EU members?
Well, for me, I saw the headlines by one of the EU members saying, "Oh, we have to be prepared for doing things without the Bundesbank, etc." I think Germany is the heart of the European Union, and nothing can happen without Germany. I mean, that's my opinion. And basically, they were the ones behind the whole idea, right? Germany and France.
Well, they're behind what are they coining it? The Franco-German.
Yeah, coronavirus relief thing.
Right. So, well, if Germany's behind it, what's the problem then?
Yeah, I mean, Germany is the most prudent country fiscally out of all of the European countries. So they have to keep up some kind of level or appearance, let's say. So they're going to be against completely irresponsible fiscal strategies. But at the end of the day, they have to agree on something, because the future of the European Union is more important. In my opinion. So I think there's a lot of noise, there's a lot of politics being played in the background, but in the end, they're going to have to agree on something. What is it going to be exactly? I don't know. But I think the risk of people are saying, "Oh, the European Union is going to break up and this and that." I think in the long term, it might do, but not now. So,
Irina just said that Austria and Denmark are against the support grant only fund, and France and Germany will vote for the support fund. And actually, there's two other countries too that are really against. There's like 4 countries in total that are not on, that are not wanting to agree to this.
Yeah.
Not only just Austria and Denmark, but a couple
Netherlands
other countries.
Netherlands and, well, anyway, yeah. I agree.
But anyway,
yeah, there is dissent, but I think at the end of the day, this is all politics, as is everything. So,
But do you think it's something that could really, support the euro as a whole? And that's where I think that the market is looking is, whatever they decide, they're going to decide, but will it strengthen the idea that the euro is a viable currency, and it's not just some sort of science experiment, if you will, and
they're all science experiments.
They all are. Well,
yeah,
I'm sure.
They're all fiat currencies backed by nothing, and in the history of fiat currencies, which started in essence in 1971, the only certainty after 50 years of data that we have is that they've all been depreciating really fast against anything tangible.
So
far,
Steve,
not going well.
what are your thoughts about the euro here?
My thoughts are that if we break above 110, nothing is going to matter on a fundamental perspective because that's going to be a big technical breakout. That's what I think, and I don't think we need to overthink it. I doubt it. They're going to agree to anything that is really substantial. I mean, I can't see, finding support among the important countries to do something like that. But at the end of the day, won't really matter. I think that even from a technical and positioning perspective, a squeeze can really take place above 110.
Yeah. And just I want to add to Irina's. She said, "Yes, I'm based in Austria, and I know the government's attitude." So, thank you for your comments, Lorena. I appreciate that. Irina, I appreciate that. And I agree with you, Steve. A solid breakout above 110 and a sustained break above 110 is going to be quite bullish for the euro dollar. And for me, I'm actually looking at not just the euro, but like the euro sterling that's pulled back. Remember, we have a range extension, and God, I feel very fortunate that I got on my euro sterling at the 89 80s last week. But we're pulling back to like the breakout point, and you can have currencies like not just the euro dollar, but the euro sterling, maybe the euro Aussie, which is, by the way, it's testing some pretty key support here. The euro New Zealand, you can have the euro crosses really rally as well, and that's something to think about instead of just focused only on the euro dollar, which I think could really break out above 110. But there are other opportunities in other pairs that you can see some extensions on. So, but yeah, now, Steve, yeah, I know for the longest time, you've been kind of, I want to say, not so sure about the eurozone experiment, and you're obviously in Greece. So how do you feel about like the market looking at the euro as a unified union, if you will, moving forward?
Not going to happen easily. I think that making guesses about the future of the eurozone is extremely hard because so many factors play in. If I had to make a guess, it would be that probably the only way for the eurozone to survive in the long run would be to be separated in at least a couple of tiers and have the strongest countries form the core, perhaps with a different currency, and perhaps the weakest currencies, a tier 2 type of thing. But that's something that might take, who knows, 5, 10, 20 years to end up playing out. So I don't think we can really base our trading on that. As long as there are no substantial jitters, like for example, as long as there is no scenario that is like prevailing that one of the big countries might be leaving or whatever, I think that the euro can perform rather decently in the time ahead.
Yeah, well, I tell you what, I don't trade European indexes, but if you want to see like where the laggards are, boy, I think some of the European stock indices like the DAX will probably play a little bit of catch up with the S&P.
You should have a look at the Italian, the Spanish stock indices. I mean, they look like they're a disaster.
You know what I'm going to do is I'm going to actually leave that for you, so you can take a look at some of those indexes with the group. So I want to thank everybody for being here. I hope everybody had a great long weekend. Remember, if you haven't tried out Forex Analytics, make sure you do so. And then also visit Forest Park FX. They are our webinar sponsor if you're looking for a new broker. I'm going to pass it over to you, Steve and Stelios, and Coach as well. You guys have a great one, and I'll see you. I'll see you soon.
Bye-bye,
mate. Thank you.
Thanks, guys.
Data
how you
coming
doing,
out.
Steve?
I'll see you on the
in-
daily roundup today. That's what I was going to say. All right.
See you.
Data coming out in a second, actually. Let's see.
What
US
data do we
consumer
have?
confidence.
Oh, yeah.
US new
No.
home sales.
No, that's in an hour and a half. It's not now.
Oh, sorry, I didn't
Yeah,
notice
yeah.
the time. Usually we have data at the at the bottom of the hour, so I assumed it was at
Yeah.
3:30 my time. But then yeah, you're right. We have no data actually for
Yeah.
3:30 my time. My mistake. Yeah, those are for in 1.5 hours. So go ahead, Stel.
Yep. I mean, just continuing first on the whole euro thing. A lot of my friends ask me, what do you think about the euro? What do you think about the euro dollar in particular? My answer continues to be, because remember, I don't look at markets intraday or short-term moves like you guys do. My answer for the last year and a half has been, I am extra neutral. And if you look at the range of euro USD in the last year and a half, it's been between 105 and 115, which in the grand scheme of things has been pretty tight.
Yeah.
Obviously, it's going to go up and down quite a bit in between, but overall, I don't see something that's going to push me one way or another. I still
As
think
you
that.
know, Stelio, I'm
Yep.
of exactly the same opinion.
Yeah, I mean, the short term, like you said,
yeah.
110 is a big
With-
level.
Yeah, with an asterisk though, having to do with USD yen and Euro USD, I've been saying for more than a year, don't trade them. Like, find something else
Yeah.
to trade, which I think
Yeah.
has been the best advice. The asterisk having to do with the Euro USD, in my opinion, as I've said multiple times, is that the next big move is going to be higher whenever that comes. I'm not saying that it can't keep leaking lower until that happens, right?
Yeah, I agree with that.
But I
agree.
think that the next big move, I mean, the type of move that we haven't seen in a long time, is going to be higher.
Yeah, I agree. So, that's my view on that. And it's been like this for over a year. So, enough about the euro. What else? We had today, actually, we had Andy Haldane from the Bank of England, who is the chief economist of the central bank. He actually mentioned that the Bank of England is not, a quote, is not remotely close to any decision to take interest rates below zero. So this actually gave a little bit of a push to the pound, because remember, we are pricing slightly negative rates. And of course, the counter argument to that is, if you see people talking about it, even if they're dismissing
Yeah,
it,
of course,
they're
of course.
talking about it. So,
and in essence, to translate, what he meant is that the stock market levels are nowhere near what they would need to go to negative rates. That's what he meant.
yeah, exactly.
Because if we didn't even end up having some of the world indices like the Nasdaq being a breath away from all-time highs, you can bet that we would hear totally different stuff coming out from their mouths.
Yeah.
So
that's what gave the pound a little bit of a push. Obviously, also the pound has been trading in line with risk for the past week. So
we've said that, which is very weird, actually, right?
Yeah, exactly. I mean, it's a short-term correlation, which will probably continue until we're out of this coronavirus thing. So equities rally, the pound rallies. That's what it's been like.
Yeah, speaking of which, the pound has to make a very important decision here, Stelio, because we didn't fulfill this head and shoulders formation target. And if we do close above this confluence of resistances, among them is the neckline, then there is a very good chance that we're going to be on our way a lot higher. So quite a key day today for the pound, and not only for the pound. I'm going to show more stuff, but what else did we have from during these days from the fundamentals perspective and news? And
actually not a huge amount. I mean, we talked about the main things. We continue to have this tug of war between the US and China in terms of what's going to happen. Huawei with the 5G contracts. There's a lot of countries who are saying, look, we're not going to let them be a part of it, and infrastructure and all that. It's huge for the future. So
I have to give it to them. They're brilliant. They are brilliant.
Chinese or
no. I mean, this whole charade is magnificent.
Yeah.
I mean, now that US stock indices are almost at the highs with all this like stimulus, irrespective of 30 million unemployed people and all that. Now, of course, they have the ability to ramp up the US-Chinese game. I bet you that in the first signs of trouble from the stock market, we're going to get an extra stimulus package in the form of, we've been having nice discussions. We've already started talking about the possibility of moving forward with a level 2,
phase 2, phase 3, etc.
Phase 2 deal. Yeah, I bet you, and that's going to be enough for some time as well.
Yeah, I mean, I think at the end of the day, we're still in this two-way fight between the governments trying to reopen economies and the damage caused by this whole closure. So is the fundamentals, the economics, the hit that we've had over the past months, and which will probably continue, is this enough to bring economic activity lower and indices lower, or are we going back to exactly where we were and better going forward? I think the issue now is that we can safely say that equity markets do not reflect fundamentals anymore.
What?
That's the thing. Yeah, I know. What? I've had this discussion with many friends and people who ask me, they say, well, how can equities be up there? We're not even close to being where we were before. Well, it's not the same. It's not a one-to-one relationship. I think I've said this before. I think eventually we will correct lower.
You say it's not a one-to-one relationship, but do you know what is a one-to-one relationship?
What's that?
Let me show you.
The balance sheet.
This is now a one-to-one relationship.
There we go. Yeah. Fed balance sheet and that. Yeah, exactly. So
what does this mean in essence? In essence, it now means, you remember how many times I've laughed during the past few years with Bernanke's
saying that it was temporary.
Not only that it wasn't debt monetization because it was temporary, and they were saying, before we got all that this is a joke, and we're going to make it even worse. Obviously, now as you see, every single dollar being issued in essence is monetized, right?
That's amazing.
So that's it. I mean, it's a perfect relationship now.
That chart should make anyone very scared about dollars, being long dollars. I mean, I know the world needs dollars, and there's so many transactions done in dollars due to the petrodollar and a whole lot of other stuff. But I mean, that just scares the hell out of me in terms of the purchasing power of the dollar going forward. I don't mean today or next month or next year, but going forward.
Those things don't work overnight. Yeah, obviously. Yes, I mean, they
Dominic also, our friend Dominic is also saying they've passed the point where now more than half of the money spent is not from taxes.
Yes, I think something like 49 cents of every dollar spent are coming from taxes, and 51% coming from debt issued.
Yep.
So
and with rates here, why wouldn't they issue debt? Why wouldn't they just
with continue? The pace, of course, with the pace we're moving at the moment, as you understand, it is a matter of likely days for more than half of a dollar from each dollar coming from issued debt, right?
Yeah. Anyway, so that for me is the main thing I look at every day. What do I think about these equity markets? Because let's face it, equity markets
by
are
the way,
everything.
Debt surpassed 25 trillion.
25 trillion. Wow.
A few days ago.
And this was what,
just look at the number.
Trillion 10, 15 years ago, right? Less than a trillion. Yeah. Okay. It's a bit crazy. I mean, looking at that, you have to say that in the long run, you have to own everything, anything you can own, equities, land, anything tangible, especially, but even equity indices, they're based on companies which own tangible assets and which create products or services. So I think, if you close your eyes, you open them in 30 years time, the S&P is going to be at, 10, 15,000 or whatever.
And look at the trajectory, since you mentioned it, look at the trajectory of the debt per 20 years.
Yeah.
52%,
yeah.
35%, 58%, 120%. But, the most worrying part is that the trajectory of the deficits has gone really vertical. So from 120 to 150, we might be months away.
Yeah.
I know it sounds like a joke, but it isn't.
Yeah, and our friends, either Sergey or Serge or something, he says, what about unfunded liabilities? That's a very good question.
Yeah.
They're
No.
massive.
Don't
massive.
mention unfunded liabilities.
And they show up nowhere. So, it's just a ticking time bomb. So yes.
Yeah,
very
don't
good
mention
question.
unfunded liabilities. The number is out of this planet. It's above 100 trillion
Yeah.
for the
Yeah.
next 10 years. So don't mention it. I mean, keep in mind that if the US or whichever other country, right, was a company, it would be illegal not to include unfunded liabilities in the balance sheet, which of course different rules, accounting rules, apply to governments. Because imagine if they had to include that. Imagine the budget deficits if you had to take provisions for the debt you're actually accruing accumulating for the future at the year you actually made that happen. I mean, we wouldn't have almost no economy would have a deficit of less than 10, 15% per year.
I think these unfunded liabilities are one of the main reasons why you see debt exploding, because they have to fund them somehow and they have to borrow. And if you look at it, everything they've been doing over the past 10 and 15 years is to bring interest rates lower, everything, because they need to borrow more, because they need to be able to fund these. So imagine if interest rate, 10-year rates were back at 8% or 6 or 7, it would have been a very different story. So
it's an unsustainable game. And it's 100% the grenade game. You've taken the pin out of the grenade and you're throwing it down the road.
I don't know that game, but it sounds scary, man.
Yeah, it's not, hoping it's not going to explode in your hands and will explode in the hands of the next one. That's that's the only thing it is. In any case, back to the charts, because we do have some interesting developments. Now, there's no surprise that
I've been told I was a funded liability.
No,
only by employers during my life.
It's not a surprise that we've broken out from this triangle in the S&P. We said that there is a big likelihood. We had even drawn this, a projected continuation. And I said many times that, listen, whatever the S&P does, expect the Aussie and the Kiwi to do, and of course the Aussie yen and the Kiwi yen. So you see the Aussie, you see the Kiwi, you see here the Aussie yen, you see here the Kiwi yen, which is breaking through a key area of resistance. So looking at the charts, it looks like we might have more follow through in the days ahead. Key area here for the S&P, I actually added a little bit to my shorts today, another quarter, so I'm now 3/4 of a position here. But I do definitely see that we can push even towards the 3140 area, the 78.6. So I'm not sure we're going to see a reversal immediately, because looking at more charts, for example, look at the USD CAD. The USD CAD is in the precipice. Actually, as we speak, it's trading lower, but nobody says that in an hour or so can be back up above this confluence of supports. It's now trading lower from this triangle. And if you remember, many days ago, I had said in advance that, listen, there are two paths forward here for the USD CAD. One of them is that this is the big triangle here, in which case, we break, straight higher from there. The second one is that, the triangle you should be looking for is this one, in which case you should have, this trajectory, meaning another push lower, perhaps towards 136, where we find the 61.8% fib from this move higher and then higher. And as you see, the USD CAD chart looks very, very similar to the DXY itself, right? Here it is, a move lower, a triangle. Now, admittedly, the DXY has not broken lower yet. And in order for it to confirm doing so, we would need to roughly see a move below 98.50. But I think it's quite likely Euro USD is attacking 110 once again. We know that the Euro USD is the biggest component in the DXY. Another component in the DXY, and this is a beautiful chart, is the USD Swiss. Look at it. This triangle is really running out of space here, right? So, one way or another, we should see, a breakdown or a break higher, within the next few days. I mean, there's not much space left here. So, it looks to me like it's a very decent likelihood scenario that, dollar pairs are going to continue to move against the dollar for a period of time. For the same period of time, we might see the stock market, rally even further before we see some deeper correction, and we see the dollar catching a bid. So, that's the scenario I was looking for in the DXY as well since days ago, and it might, with a delay, it might actually play out. So USD CAD, USD Swiss, Euro USD, the cable. I already showed the cable before when we were talking with Stelios, showing that it's in danger of invalidating this head and shoulders formation, which on itself is going to be quite a bullish development. All of them are pointing, as long as we close like that on the day, because we've had quite a big movement while the markets were closed. I mean, US indices, for example, are roughly like 3% higher, from Friday to today. So, we might see some kind of a pullback or even a reversal. I doubt a reversal. But as long as today confirms that this is the case, I think we should see some follow through in the days ahead. Now, I'm still a believer that we're going to see, if you want to find value in owning these things, meaning US indices, commodity currencies like the Aussie and the Kiwi, I think that you should first wait for a rather deep pullback. I'm actually short the S&P. I was long until 28.55. I started reversing from there, knowing that it might take a lot more before we move lower. But I funded my stop loss by being long, and I feel okay by being short. But you need to know what you're doing, and you need to be very careful, because as I said, I don't really see a reversal lower imminently. It might take days. It might happen next week. Who knows? For the time being, risk assets continue being in la la land, completely disregarding all the damage that has already happened to the economy, including all the added debt to try to somewhat recover from that. Because for some reason, people have started completely ignoring that, even if you manage to throw so much liquidity to the market that, stocks recover, the damage you're doing by, indebting the economy further. If you remember, Dale, I had made the assumption that once we went in a recession, the US deficit would move towards 11, 12%. I was mistaken. It seems that it's going to be something like 15%,
Yeah.
which was above my, way above my expectations. These developments are extremely worrying and definitely extremely negative for the real health of the economy. For the time being, of course, stocks couldn't care less about it. So, it's one thing making economic predictions, which, you might be good at or not. But, I know people that are very lousy in making economic predictions and make good money from the market. And, people that do the opposite, people that do good economic predictions and, are lousy traders. So, if you're a trader, it's nice if you can also make good economic predictions, but the most important element is to be able to trade, profitably, and the rest are just to have discussions, and for your friends to tell you, oh, you actually said that, good for you, you had good foresight. But who cares? That that doesn't fill your wallet, right? Now, another pair I'm watching and I'm short actually is USD NOK, still doing very nicely here. Got rejected once again from this descending channel. So so far so good here. Now, gold and silver. Gold on one hand is actually, I want to go to the 4-hour chart for gold specifically. So here's gold. So gold is not appreciating despite this dollar depreciation, but I mean, does this look anything else than a corrective move to you? Because it doesn't to me. I mean, at 20th of May, this is what I predicted is going to happen here, another leg lower and then higher. And if you want to isolate this formation, first of all, we remain above this previous broken triangle. So as long as that's the case, there is nothing really to discuss that will convince me that we should be looking lower. But second of all, I see another triangle here, and the price action looks very corrective. Now, silver, you've mentioned that example many times, Dale. Silver looks a little bit like a beach ball to me. I mean, remains very, very well bid. Seems to have been consolidating in this range, and I wouldn't be surprised to see. Actually, I mean, I'm assuming that I'm going to see at least another squeeze higher towards 1850. I think that silver remains very undervalued, and I think
we'll
silver
have
can
equality in the gold silver ratio at 96. So I don't know how close we are to that, but the first break.
I can tell you that with the rate we're moving, we're not far away from it
that's
anymore.
what I mean. That's why I brought it up.
Because we're at 99.30 something, but just look at how little time it was required for us to move from 130 to 99.40, right?
Yeah.
And
well, I'm just talking about equality. The first break was 20.
I know what you mean. From this move lower to that move lower. Yeah. Absolutely. Yeah. But in essence, just look at this. I mean, I don't see any real support until we reach 93.30.
Yeah.
That high there. So I don't know. It looks to me like this can keep on moving lower for, much longer than people might assume. Let me go through some of the questions and see what people want to have a look at. So let's see. Let me take it from the beginning. Forever wars industry, USD CAD fooled everyone and went the other way. Yeah, I mean, we haven't broken down yet, but it looks like it. It looks like we might squeeze towards 136 before we can actually move higher from there. The news in Bloomberg are huge for Euro. Buy ASAP. Wonder how Steve and Stelios see them. You now know how I see them. I still, first of all, insist that until we see a breakthrough 110, and by 110 I actually mean like 110.10. We have this confluence of resistances roughly at 110.10, something like that. We're still in a range, but yeah, I do think that there is a big risk for a squeeze higher. There's a question about USD Swiss, which I covered. As you see, the triangle has tightened very much, and there is a big chance that we're going to break down from it, and I assume that's going to produce follow through. Irina's comments I'm not going to read because Stelios has already done so before, having to do with the Austrian and the Denmark economies, and thank you for those comments. What is your views on France? Yeah, the CAC. No. There it is. Okay, my viewpoint about it is that it looks very, very bearish. Because it's one of the many European indices that more or less shares this type of a formation, which is a big recovery that when you trade it in the shorter term, it looked like a big bull market, but in essence, it's a big bear market rally. So you can see how weak the recovery is in comparison to US stock indices, and I expect that all of those are going to fail. If you see the Italian, the Spanish stock indices, all of them look more or less the same. So look at the damage, the technical damage here, and you'll see that the probability of a new high from here is a very low probability. Exactly as US indices looked before they really got propped up by unprecedented amounts of liquidity, right? And the Fed having to make 10 different special purpose vehicles to, in essence, buy everything out there, everything. Keep in mind that the Fed's balance sheet has increased by 3 trillion in a matter of 2 months. But as long as in the Eurozone, there are countries like Germany, thankfully, in my parentheses, my personal opinion, thankfully, there is no chance that you can see that kind of a monetary insanity at that extent, happening in European countries. And as long as that's the case, as long as we can't get like a huge bazooka, expect the technical damage to prove to be, the proper indication, which means I don't know if we can actually post another leg higher from here, or if we're going to just, straight fail from there. But I expect that even if we, rebound a little bit further, there is absolutely no way that we can cover all this before we turn lower once again. And if that happens, it's going to take a long time. It's not going to be an easy process. It's not going to be like a 2-month, pedal to the metal to the pedal, whatever it's called, all the way up. So I think it looks weak. Now the formation can be something like this, right? Something like this, or something like this, or whatever. The problem with corrective formations is that you never know the exact nature until you have more price action. But I predict they're going to be moving lower. This means the S&P Euro shooting up. Yes, the US also passed the point where now more than half of the money spent is not from taxes. Yes, that's almost true. As I said, it's 49 cents on the dollar, but I think it's a matter of a couple of months worst case scenario before more is coming through issuing debt. Unfunded liabilities, we talked about that. The US is blocking companies from China from doing business in Israel. They are worried because of security reasons. Gold, silver, platinum, Italy index, I spy in IBEX. Okay, listen, here's the IBEX. As you see, same thing with the French indices, different formation, but still same type of thing. So, we might see another leg higher. We might. Something like that. But in any case, I think that we're going to be moving lower following that. Italian stock indices don't look different. It's more or less the same thing. Gold, silver, platinum. I covered those with the exception of platinum. So let's have a look at platinum. Platinum, here it is. So platinum still recovering, but keep in mind, I had said in advance that this 875 is a key area of resistance. And we got rejected initially from it. And I wouldn't be betting on the bullish side as long as we're close to it, right? You're not buying something close to a key resistance area. So bottom line, yeah, I think that platinum is extremely undervalued, fundamentally speaking. But no way I'm buying it close to 875, right? Now, if you see a real breakout from there, that's a different type of a discussion. Can you go through the VIX? Yeah, absolutely. I mean, the VIX is doing what you would expect for it to be doing just by looking at the indices, which is, it keeps dripping lower. Still nowhere near, where it was. Key support area for the VIX is roughly at 25. So be careful, and also notice that we've started developing at a much higher plateau. We've started developing a divergence here, right? The VIX is still quite a lot higher than the spike low we had several days ago at the 20th of May. 12th of May, despite indices being higher at the moment, right? So this is another thing I'm monitoring, in conjunction to what I just said, that 25 is a key support area in the VIX. I'm also going to be paying attention to this potential descending wedges trend line resistance. I think that if we squeeze above it, we're going to see, a fast acceleration above, perhaps even a retest of 50. DAX, sure. Here's the DAX. DAX, same deal here. I mean, this was a pennant likely. I said probably another move higher towards the 61.8. Guess what? I mean, that was fast. We are at the 61.8. So what's this area as resistance? But there is also a chance that we can squeeze even higher towards the 200-day daily moving average, which is at 12,000. So what's that? As well, if we don't fail from here, watch for 12,000. Okay, and I would be expecting a much deeper correction, from there if we don't make it here.
Gus is here.
Oh, okay, coach. Sorry, I didn't notice the time.
It's okay. I let you finish.
So, yeah, we probably have more questions, but you know how it is. I mean, we have limited time. More in the chat room. Who do we have today, Dale?
We have Michael, mystery trader, very big
yeah,
following.
yeah.
So he's going to continue with his narrative. He's been here twice before, and a lot of his
Indeed.
forecasts have been good. So Michael, I'm ready to make you a panelist, and we'll get going
Enjoy
on
the
the interview. Thank you, Steve.
Do you need any help, coach?
I don't think so.
Dale, can you hear me?
Got you, Alex. How are
Perfect.
you, buddy?
Good. How you doing, brother?
How are you, Michael?
Good. I'm good. It's Alex here. Sorry, I don't know if
Oh my God. Oh yeah. All right. So, really looking forward to hearing your this is the third part of the market trilogy of yours, correct?
Correct. Yes. This is actually, believe it or not, this is actually our 1 year anniversary, Dale.
Oh my gosh. All right. Happy anniversary.
Yeah, I know. I didn't bring any flowers or chocolates, but I definitely brought a lot of gifts for you.
I bet you brought great content. And do you know how to share your screen here on,
one
Zoom?
second.
Let's see if you can, if the frequency of your appearances can be higher or lower than launching of quantitative easings.
Yeah.
That's actually, I mean, I don't know. I might be having trouble keeping up with that.
I know. I know. It's going to be quite tough, right?
All
Okay, so
right,
can you see my screen here?
We've got it.
Okay, perfect. Awesome.
All right,
well, obviously, good to be back. I appreciate Dale inviting me back on. We had quite a couple of meetings the last 2 times. I think the last 2 times we did was in May and August of 2019. So I kind of wanted to open up for those that maybe didn't view last time, kind of do a recap of part 1 and part 2, and then we'll kind of get into where we're at now in the global economic backdrop. Then we'll kind of break down into the various different forex pairs, and then from there we'll kind of touch on bonds, gold, Bitcoin for a bit, and then kind of tie everything all in together, at the very end.
Let it rip.
Okay, perfect. So this is for those that didn't get a chance to follow us on. This is actually May last year, almost exactly a year to the day. In part one, we discussed how I saw a lot of signals of most of the world's currencies reaching parity in unison at some point in the near future, or I should say, in the relatively speaking, and that the Fed would transition from tightening to easing. That obviously happened. That crypto crackdown via the IRS, that they actually weren't safe or private or secure, that obviously ended up happening as well. Obviously, I suspected that a hard Brexit would happen, and then from there, ultimately, would lead the Great British Pound lower faster than euro. I happened to, and this one was kind of sheer dumb luck, but the DXY would reach 94 by March or April, and then a huge spike would happen. I was technically right on this one, but caveat, it was for all the wrong reasons, and we'll discuss why. But technically, that did happen. And then before any sort of rush to parity, there would have to be some sort of a global recession to occur as a catalyst in order to, establish the backdrop for, some sort of a transition. And sure enough, I could not have predicted in a million years a global pandemic, but obviously in the charts, there was a signal that something was about to happen.
Yeah.
And then in part two, we discussed how Fed would go. It would, at that time, for those that don't remember, they had just done one and done, and they were claiming, "Oh, we're not going to do anymore." And obviously, I said, "No, the Fed will be forced to go full easing." And we got way more than just full easing. Great British Pound at the time, I said there'd be one more macro bounce, and then a back test rejection, and then it would return to 120, and that would happen in roughly 9 months, roughly around April. Sure enough, that happened as well.
Nice
and then
calls,
also,
bro.
I mean, I
Nice
appreciate
macro
Dale.
work.
I appreciate. I mean, to me, it's I literally was just looking at the charts. I'm not trying to make myself out to be some prophet or anything. I just really was just looking at the charts and saying, okay, let's look at historical patterns and see if we can kind of discern anything from the data that would kind of help, provide some clues for the future. And then at the time, I said that global parity would happen roughly somewhere in the 21 to 22 year range, 2021, 2022. And then before then, there would have to be a global recession, which is 2020. So far, most of these have, almost all of these have panned out. The 10-year yield, I also suspected would drop well below 1.4%. Obviously, that happened as well, too. I said that the long end of the yield curve will be artificially depressed. That's obviously happening now with the Fed jumping into the curve. Gold would no longer behave inverse to the DXY, and that'll be an interesting chart here towards the end. Gold started tracking U.S. Treasuries.
I also remember, though, Alex, that you talked about gold being able, maybe it was on Twitter because I follow you. That's how I met you. That you thought gold could rally to about 1,600 into the spring.
It did, yes.
2020. So, and you thought the dollar would weaken during that same time frame and into the spring. So those two were good calls.
Thank you. I appreciate it. Yeah. And I kind of get towards the end, but gold. So I said that gold would be tracking bonds, and sure enough, they were lockstep. I have a chart for that, which will be great to look at. And then that gold would ultimately be used as a weapon against crypto, moving that ratio higher. I have a chart for that as well. And then eventually gold will be above 2,500, and we're en route to that now. Two things I was wrong on. One was extreme CAD strengthening. I don't think that's necessarily still wrong. I think I was just early on that call. Obviously, the crude crash definitely hammered the CAD significantly because it's such a sensitive to global oil prices. So that kind of weakened the CAD. So USD CAD obviously shot up. And then gold actually never ended up dropping below 1,000. I'll actually explain why, although I was wrong on that one, why this actually further proves the theory correct ultimately, because I'll go explain case by case how that's actually a good thing for both gold and also for the total narrative. So from here, now where are we now? And this is kind of, I just want to take a moment to kind of get a backdrop of where we're at. Although the actual cause or catalyst of the global recession was impossible to predict, ultimately there were signals in the charts, on the big macro charts. Obviously coronavirus is a black swan. There's a known knowns, known unknowns, and this was an unknown unknown. There's just no way any of us could possibly predict this, but it is highly coincidental that coronavirus provides the perfect backdrop for not only the consolidation of potentially currencies, but ultimately political power. And this also ties into the global forex parity thesis that I spoke about last year. On top of that, this is the worst employment recession we've had since the Great Depression, and literally all the jobs erased so far were erased everything from all the way down to March 2009 in just 2 months, whereas in the Great Recession, it took 18 months. So this is kind of the general backdrop of where we're at now. Obviously, these are, very trying times for a lot of people, and obviously everyone out there, hope you're safe and sound and happy. But, it's more importantly, I'm not here to talk about the virus. I'm not an epidemiologist. None of us are. We're here to look at the signals and see what kind of trading signals we can deduce or decipher from a lot of the data. So this is kind of just a basic economic reality check. Thus far, we've had 39 million jobless claims already, yielding so far in a 14.7% unemployment rate. I doubt that's peaked. It's probably going to go a little higher. We have $2 trillion in the first stimulus package, and thus far this year, the Treasury is looking to issue over $3 trillion in debt. And keep in mind, this is happening in a period where Treasury has to issue $3 trillion in a period of reduced tax receipts, and obviously the IRS has delayed their tax deadlines and thus whatnot. So never before has the dollar been under such pressure, going back literally decades. And so, well, how does this affect the overall COVID reaction on global debt? Well, as a part of my thesis, I said that the global elite need to create a condition in order to bring about some kind of a globalized world currency. In order to do that, you have to go through a 4-step process. And this process, it's no coincidence that this playbook that I'm showing right here now is taken basically directly from the IMF. And I don't think it's a coincidence that Christine Lagarde also happens to be the head of the ECB. I mean, this was essentially her playbook. And you even hear kind of rumors about new Euro bonds and kind of a higher supernatural form of debt in the Eurozone. So they're already starting to talk about a lot of this, but essentially the 4-step process is: first, you create a global recession to weaken sovereign strength to the point where that'll transfer power from national bodies to kind of super governmental bodies. You have the WHO, IMF, and so on and so forth. And then in part
I kind of
two,
felt that way too, that it wasn't an accident that Lagarde, with her background, would move to the ECB during the credit crisis.
No, and we discussed that both Ursula and Christine Lagarde moving into their key positions. In part 2, we talked about them putting their chess pieces in place. Okay. This was literally their queen chess piece, no pun intended. Okay. She's literally the queen. So that is not a coincidence whatsoever. I mean, she's not even a central banker; she's a politician. And then right. She's not really bound by any, whether it be Austrian or Keynesian or any kind of form of economics. She's just a politician, and essentially she's the perfect pawn.
She's not even French. She's
no.
a one world new order gal.
Oh, for sure. Yeah, absolutely.
Yeah. Okay.
And then once this initial global recession would happen, that would force some sort of expansion of central banks' balance sheets, in this case, the Federal Reserve, and that would force to issue some sort of extreme stimulus response, similar to 2009. But at the time when we discussed this last time in August, never in a million years did I think, have you told me 12 months from now we'd be issuing $2 trillion in debt, I'd say you're crazy, But sure enough, this is our reality now. And so in part step 3, you would then monetize extreme new debt expansion through new issuance of both new government-dominated debt, treasury bonds, and also to devalue existing national currency. So just in this 2-month period, it's hard to believe, but from beginning of March till now, we're already done steps 1 through 3, which is kind of scary when you think about it. And then the transition from 3 to 4 is going to take significantly more time, but that's essentially to provide a global currency as some sort of supranational lending mechanism that then countries can then draw on. You see this pattern that IMF uses with a lot of third world countries, developing world countries. You get them stuck in this debt trap, and at that point you have them. And they're using essentially the same playbook, but now they're doing it on a global scale. And ultimately, at some point, countries will start drawing on the special drawing rights, or SDRs, which in effect is essentially the mechanism has already been in place, the infrastructure, but it hasn't really been utilized because there was not a global crisis large enough to justify that. Well, now we finally have that global crisis. And again, I don't think it's coincidental.
Yeah, SDRs have been out there for what, 10 years?
A little bit over that,
structure of
actually.
it, yeah.
Almost 15 years.
Okay.
And it almost completely unknown. Most didn't even know they existed. It was, you wouldn't know unless you were looking deep into, some long governmental report, which nobody ever reads. So, but the structure's actually been there, but
Okay.
it's just never been accessed, other than a very few kind of developing world countries that were in a really bad bind or something like that. But they've been kind of testing it out for some time now, but again, not on a global scale.
Okay.
So that kind of brings us to like the Forex update, and I'll kind of break down through all the major currency pairs and kind of what signals they're sending, and kind of retouch back on some of the motifs and narratives we talked about last time. And the first one of those is the Euro US dollar. And I know for many of the Euro dollar traders out there, recently have been very frustrating over the past few months. And I've kind of gleaming over Twitter to kind of see what the general consensus was, but not a lot of people are understanding why the euro was so range bound currently at the time. And the real reason is that on the monthly chart, if you look at the monthly Bollinger Band, it's a complete flat brick wall. And anytime you have a very, very flat monthly Bollinger Band, it acts as either a hard support or hard resistance. And that lower Bollinger Band was between 1078 and 1080. And it's just been hovering in there. And earlier in the month when we were down, it was kind of curled a little bit downward, but now it's completely flat on this bounce. And I think that this supports the thesis that, last time I talked about, we're going to have this long sort of cyan consolidation period, which I'll show in the chart in a second, and we'll come back to this.
Okay. So over 110, a lot of people are saying 112, 113, that wouldn't change the picture anyway, would it?
No, in fact, I'll get to the actual targets in a second, but right. I actually think based on what I'm seeing, and I'll kind of explain, tie all the pairs in, that there is a very real possibility we can pop back up to either the 50 or even this blue trend line once more, which the red 50 monthly moving average, is at 1142, and the blue trend line is at 1145. So somewhere in that 1142 to 1145, and I'll kind of these are just random targets. I'll explain why I think that is. But thus far, Euros seems to be pretty, and ironically enough, this one technical indicator is, holding much of the Forex world hostage, because it's 57% of DXY, which a lot of other currencies pull their signal off of. So it really is a very, very key critical technical indicator that a lot of people may not be looking at particularly, because most people don't look at, very long monthly charts, but this is very key. And so definitely always keep this one indicator in mind. And until that really starts to curl down or open up, you're not going to be able to have any sort of measurable move to the downside, which actually ties into my thesis, and I'll explain why in a second. And then on the next chart here is the British pound dollar pair. And back in August, I predicted, this is right around here, this was the last time we spoke, that we were going to have some sort of a 9-month bounce off this green line, exactly like this period here. And if you looked at two periods are extremely analogous to one another, you have bounce up into a 13 and 50 monthly moving average, and then come back down, and that this period would be exactly 9 months. Sure enough, it actually ended up being exactly 9 months at this time again. And you're seeing this kind of same pattern developing. Nice. So this pattern, this is kind of the last throws before you have some sort of a major move. And in this case, the previous one, there was a big drop, and then there was a back test, and then went lower. I'm not sure if this pattern will necessarily repeat, but just be aware of it. But you can see here that the lower Bollinger is starting to curl downward. And in order for this pattern to prove that it's going to take the next leg down to parity, that it has to happen in June. So in the next 30 days, we'll know if this is actually panning out. And sorry, there we go. Yeah, and then on top of that, I wanted to also take a look at the pound euro as well. And this is also a very interesting chart. And the last time we spoke, we were actually right here. We were hovering right at this orange key trend line, which is very analogous to the previous orange period back here between 03 and 08, coincidentally, right before recession. And when I discussed that, I said that we would have, 3 test bounces, and then we would have some sort of a breakout of the 50 monthly moving average, but it would be a head fake signal at this purple arrow, and then you'd have the true move happen. Sure enough, the exact same pattern textbook is happening yet again. You had a false breakout above the 50, possibly, to trap bulls or get people, in, and then position one way, and then right at the purple arrow, and sure enough, we're now starting to roll over hard again. So, and if we look at the MACD, these are customized MACDs here that I designed specifically for this chart. You see you have a very similar pattern. You have these kind of periods where they're touching again, and then it ultimately ended in a center line, a bearish reversal rejection. Sure enough, we had the same exact pattern here, MACD touch, and then it finally had one last pop up in this 50 moving average overshoot, and then now it's starting to roll over and starting to cross bearish. So this two cyan.
Why do you pair it pound euro instead of euro pound, which is how it's traded? Any reason?
Yeah, the reason I do this is because it ties into the global forex parity thesis, so that all the charts are moving downward. So it's just more from a graphical standpoint, just to kind of illustrate, because ultimately, they're all above parity. So I invert the chart in order to kind of, show them kind of going in unison. It's just more from a graphical standpoint, nothing else.
I got it. Okay.
But you can use this obviously inversely and trade on it. And then also, if you look at these previous periods, you had these kind of, anytime you have a stochastics cross below the 80 line, that's usually a very bearish signal. It happened one here, right, the last time this happened, and sure enough, it's happening again here. So the pound euro is starting to show signals that it's going to have its next major move to the downside. And now I don't necessarily think the move is going to be nearly as drastic this time, but I do believe it's going to go and revisit this blue, bear channel support, similar to it did here, and then it'll kind of consolidate. This last spike was just because of the 09 bottom, and it kind of really flushed out. But if you look, now that we're within the parity window on pound euro, I hypothesized last time that the pound would have to move faster to the downside than the euro in order to reach parity, because it's obviously further away. So the pace at which it would have to drop would obviously have to be faster. So in that scenario, pound euro would have to drop. I would also have to be moving in a downward pattern on a relative basis, as it would have to be basically beating euro to parity. And ironically enough, if you go back to this chart here, the euro dollar chart, now is the perfect opportunity for the pound to kind of get a head start, so to speak, because euro is showing a decent support right now and a possibility of one more potential bounce, whereas pound is actually pretty much ready to go if it's if it can just break through the support. So that would also tie into the thesis that the pound is going to move faster. And then last time in August I spoke how I thought Brexit was actually a part of this. I didn't think that was a coincidence. I think a hard Brexit was actually one of the tools that the central bankers and global bankers were going to use to kind of exacerbate or accelerate this process.
Okay.
And then so now we go to, and this is also one of my favorite charts. This is the my DXY or US dollar basket monthly chart. And as I said that last time, all the signals were pointing to us being in a cyan kind of consolidation pattern, and then I would ultimately return back to the purple support. Now, at that time, I hypothesized it was going to happen faster this time, but that was actually incorrect. It did go back into a 94 handle in April and then skyrocket. But the one thing I couldn't reconcile when that happened was we never went to revisit back at this purple trend line. And so, technically I was right for the wrong reason. So that doesn't really count. But if you look at the actual pattern, I added kind of a time scale that the previous pattern happened was exactly 37 months. And if you look, the pattern is almost forming almost identically. I mean, you had a huge pop up into the magenta bull channel center line, and then it back tested at the Bollinger Center on the monthly at this orange arrow right here. And then from there, for the next 4 to 6 months, it would challenge or test the magenta center line again, and then it would enter its kind of consolidation process. Well, if you look exactly what happened here, it had multiple tests of magenta. It back tested into the Bollinger Center line on the monthly, and sure enough, we're back retesting it between months 4 and 6, which is between last month and June. So we're now in that period. So if this chart is to back off and begin to consolidate, we'll have evidence of it here in the next roughly 30 days. But for anyone that was curious, however long that 37-month period is, that would put us at a potential bottom around 95 at March 2021. So it's kind of, the actual process I thought would be accelerated is actually happening almost on an identical time basis. So it's almost a mirror image. And if you look at the MACD,
Okay, so you're looking for the lower magenta line to hold on this pullback.
yeah, this purple one, correct. This is going to
Yeah.
hold, and then from here, we'll have the next move up, and I'll show why in a second. But
Okay.
on this one, another thing that was interesting is that this huge spike out above the magenta was obviously a systemic shock because of the huge market crash. But when it regained back into the channel, that was a signal to me that the sign consolidation is still valid, and that this spike, if it couldn't break out above 103 before the Fed was, printing $2+ trillion worth of new issuance, how is it going to do it now? So obviously, to me, I think the Fed basically turning on the printing press is going to naturally it's going to be naturally suppressive and going to keep the U.S. dollar index down, because they're just going to have to be issuing so much debt to, between stimulus and I'm sure this first round is not the last. There's probably going to be more in the future here, but this thesis where we peak here and we kind of consolidate back into 95, roughly the 95 level by March. If you look back at the Eurojolly, that also coincides with Euro forming some sort of a short-term bottom here and potentially up into the 1142, 1145 range if it's going to do that. I mean, it doesn't necessarily have to, but that would make sense. And for those who are curious, March is right around here. So it doesn't have to be a very aggressive, sharp upward move. It just could be potentially some sort of a potential bounce here and then lower. So back to the dollar chart. And if you look at the kind of MACD, it did the same pattern. It touched and then it bounced. It's doing the same with the purple arrows.
Mm-hmm.
And then the stochastics are also forming a very similar kind of high plateau and then a dip. Whether or not we get a second one, we'll see here soon, but it's kind of in the same sort of supporting this consolidation thesis. So ultimately, now that because the euro is 57.6% of this index, realistically speaking, what is going to cause some sort of a huge ramp here? And last time we spoke, I kind of hypothesized, obviously there would have to be some sort of global recession, and B, there is going to have to be some sort of a eurozone crisis here in order for this sort of a ramp to happen. And when this ramp happens, that's when you see the real move to parity. So from there, we'll kind of go and I'll kind of obviously the number one dollar demand is U.S. Treasuries, second being petrodollar. So I think it's important to kind of get an update as far as bond updates and see how that kind of ties into the narrative given the macroeconomic backdrop. So this is actually the TNX chart I showed last time, and last time we were here, it was roughly around this time period. It was right here. And I said that we're going to bounce off this orange support line similar to the 07 to 09 period. We'd have one big bounce up into a 13 moving average back test. And then from there, it was going to flush to significantly lower lows, well below 1.4, which is where this orange line is. Sure enough, that same exact pattern happened. We bounced up into a monthly 13 moving average back test, and then it flushed. And at the time, I never could have predicted, 40 basis points or whatever it ended up being at the bottom. But, because so much of the world is in negative yielding debt, or, I knew that there was going to have to be some sort of artificial downward pressure pushing 10-year yields to all-time lows. And sure enough, that's exactly what happened. By definition, everyone asks, when is the bond bull going to end? Well, by definition, the bond bull has to end soon because all treasury bonds have $1,000 par value. So the closer you get to zero bound, the closer you're getting to that $1,000 par value. So I'm seeing signals like maybe one more pop left, but on yields, which is one more drop. I'm sorry, one more pop on bonds, which is one more drop on yields. But ultimately, we're getting pretty close to zero bound. There's really not much room left here to the downside, especially in the 10-year.
Let me ask you this, Alex, with
Sure.
what the Fed did coming into what they have never done before, the corporate bond market, junk bond market.
Sure.
Have they taken away the bond market from us as far as it being a good trading vehicle?
Well, here's the irony. So everyone touts how, the narrative is that they've stepped in and it but when you realize the Fed has yet to spend one single dollar on corporate bonds, that's the irony. They
that's right. That's true. They're just getting ready to buy ETFs, but they haven't done it. Good point.
Officially they weren't supposed to start until June, and so now it's May 26th. So they're supposed to start next month. But ironically enough, by jawboning, what they essentially did was they brought a lot of private capital money trying to front run the Fed, and they rushed into corporate bonds. So
almost recovered everything.
Basically, yeah. I mean, the HYG filled most of its drop. The problem with that is it could potentially set up a much worse situation, because now all of a sudden that implicit backdrop is there. And what if the market chooses to call the Fed's bluff? What if there's another deterioration? Well, all that private money that rushed in, they're the ones that are going to be taking on the losses, ironically enough. So
the bond vigilantes come in.
Exactly. So to me, it's actually potentially they're setting themselves up for failure. They, by saying that, yet what they were trying to do was basically talk up the market. But if we have some sort of it did work. No, I have to give Powell credit. I mean, it definitely worked. I mean, they didn't have to spend a single penny yet. But the problem is, if we have some sort of a second down wave or second,
credit crisis brewing.
Yeah, and before the election, which I would bet my pretty dollar, there's going to be something before the election.
What election?
Exactly.
All right, go ahead.
But the thing is, the one thing the Fed actually did step in is they did step in to the Treasury market and actually start buying Treasuries, and that they had to, because obviously with all the new Treasury issuance, they had no choice. But it's interesting that the Treasury side is actually going to, in theory, artificially suppress these yields or depress these yields down. It's going to keep them down, because they basically are putting a floor into the Treasury market, saying we're going to buy anything, any Treasuries that we necessarily have to. Well, if that's the case, then it's possible they could pin Treasuries down at a relatively low level. And honestly, right now, bonds really aren't tradable anyways, to be honest. I mean, on the options side, the premiums are absurd. It's going to take a while of being kind of pinned at zero or close to it to kind of decay that out.
So they did. They took that market away. I mean,
they did. Unfortunately, they did, because
all right.
It was my favorite trading vehicle 2019. I mean, I can't tell you how many monster trades I had on it, and 10-year and 30 Treasury.
Yeah.
But unfortunately, that trade is, I think, based on just the premium structure alone, I mean, it could take 6 to 12 months for that market to come back, and it's going to take a while. I have a theory that at some point, let me go back to this chart. Another possible catalyst for having such a huge ramp is Treasury yields actually having to pop off zero. And Europeans, the Eurozone and Japan obviously won't be able to do it, because they've never been able to do it, pop off zero. But there could be a scenario where not only is there a Euro crisis, but if our yields were to pop off zero, all of a sudden that would start putting upward pressure on the dollar. You could also see some kind of acceleration to the upside as well. So if that's the case, the March 2021 timeline and soon thereafter, that's kind of a good target of when they could potentially start to pop off. And it may take a little bit longer than that, who knows? But that's just another possible theory. At this point, there's no, we can't predict that. It's impossible at this point. But that is another possibility. And then, so kind of how does all this kind of tie together? So I kind of want to go through, gold and Bitcoin, just kind of take a brief touch on this one, how it kind of ties into the whole narrative and to kind of do a total market cap capitalization reality check. And this, I mean, last time I kind of used this slide to kind of signify or the difference between, you know, perception and reality and Bitcoin and gold. And ironically, the very first time we talked back in August of last year, sorry, May of last year, it was Bitcoin's market cap right here was 185 billion. So from that period to August of last year, it went up down to 171 billion. So even from May to August last year, total market capitalization of Bitcoin went down. And then again, from then till now, it's down another 10 billion. So we went from 185 billion total market cap of Bitcoin down to 161 billion now. Well, in that same time period, because of gold's massive ramp, we went from originally 7.07 trillion up to 8.45 trillion, and then now we're at 10.64 trillion. So that went originally from a market cap, a multiple of 38x back in May, to 49x in August, and now we're all the way up at a 66x multiple of market cap versus Bitcoin. So for everyone talking about, you know, a lot of the buzz is, you know, Bitcoin is going to take over the world and they're going to go to the moon, et cetera, et cetera. Well, if we actually look at the data, I hypothesized last time that gold is actually going to be used as a weapon against Bitcoin. And central banks every central bank in the world has gold in their vaults, whereas none have Bitcoin. So I hypothesized at that time that why would they, you know, they're much more incentivized to allow gold to naturally appreciate to its real value versus allowing a secondary or third party cryptocurrency to take that role. And that's also when we talked about, you know, sovereign coins and nationalized crypto coins, governmental crypto coins. So I think this is kind of putting a little bit of ice water in the whole debate that, you know, somehow Bitcoin is going to, at least thus far, you know, magically, you know, just, you know, go exponential when. And here's the other ironic point I want to make here is that if you look at Bitcoin, it's ironic that Bitcoin is highly concentrated. Of 90% of the total market cap is in roughly 360 accounts. So it's a highly concentrated cornered market, and whereas gold is, you know, global, universal. And it's ironic that the very instrument that's manipulated to be higher is actually down, whereas gold that is constantly being manipulated to the downside by central banks is the one that actually moved up. So you have one that's being artificially propped up through basically artificial scarcity actually dropped down, you know, roughly 25 billion, whereas gold actually went up. Actually, on just from last May till now, gold is up 50.5% on a market cap basis. So it's literally up 51% in the same time period that Bitcoin actually drops. So that's what's giving you this extreme multiple of 66 times. And even if you look at the gold silver ratio, I mean, the gold silver ratio spiked all the way up to 126. And for the longest time, people said it wasn't going to pass 100. So you have to understand how gold kind of ties into the entire narrative of this kind of global forex parity. And ultimately, I said last time, gold I believe is a currency. I don't view it as a commodity. Whereas ironically, I view Bitcoin as a digital commodity. I don't view it as a currency. So when you look at it from that perspective, there's really not that difference. And the other thing I kind of want to talk about here is last time we spoke, which is this gray vertical line, I said that gold was going to start to appreciate more than Bitcoin was on a relative basis, and that ultimately central banks could use gold as a potential weapon against Bitcoin because it served their interest. And sure enough, since then, you've seen this kind of upward trajectory of the gold Bitcoin ratio. In fact, recently it spiked all the way up to roughly 31%, but recently it's kind of dropped back down. But it's in this upward rising channel, and the MACD is kind of crossing bullish here. So it could be a signal of another possible bottom before the next move up. So this so far is kind of tying into the narrative as well that, you know, gold is starting to reestablish itself in the global monetary order in ways that it hasn't, honestly, since the 1970s. And then if we look here at this is a Bitcoin weekly chart. This is the reason Bitcoin has faced a lot of resistance recently is because it's facing its most major macro resistant trend line, which goes all the way back to the all-time high here at roughly 19,000. So it hit this major trend line, and thus far, it's rejected so far.
What if we break out?
If we break out purely on a technical basis, anytime you have a breakout like this, you revisit the highs. However, I'm still suspect whether that's going to happen, because everyone's been talking recently of the halving, and how the halving is, for those that aren't aware, halving is when the mining proceeds from the mining basically gets cut in half, and it creates sort of a digital artificial scarcity, and makes mining more expensive, thus reducing the further additional supply, and it kind of essentially slows down the rate of extraction. But it does it in a kind of computational form. Well, a lot of this, this could end up being a potential buy the rumor, sell the news sort of moment. If we had this huge ramp up into the halving, and then all of a sudden we're having multiple rejections here on the trend line. So I will.
Nice look.
Thank you. I appreciate it. And here's where my genuine belief is, that if this pattern continues to hold this trend line, and the 13 and 50 fail as support, which they haven't, and they actually cross bullish, but if they do fail and Bitcoin starts to drop back towards the 200-day moving average, that would be a very big red flag or warning signal, not only for crypto, but that it would also further support the thesis that gold is actually going to be used more as a weapon against crypto by simply reducing the desired demand for it, because gold will be outperforming it. So if you see, if you're, every time the Bitcoin has hit the 200-day weekly average, it's held support. It did it here back in this period, and it did it also here back in this period, and it's held every time. If there were to be a third test and there would be a failure, that would be a much more dire signal. I'm not saying it's necessarily going to happen yet, but just be aware that a breakout of this purple line needs to happen soon. Otherwise, that would spell serious trouble for Bitcoin.
Okay.
And then on the next chart, I wanted to go through kind of a macro convergence and talk about combining all these together, and how does that kind of tie in into the entire narrative. Well, obviously, from part one, I got a lot of really positive feedback from the analogy that I used, which was actually the solar system analogy, and everyone said it made perfect sense. So I kind of wanted to touch back up on that. And for those who weren't there, or didn't view it, I hypothesized that this is essentially an analogy for what is the global currency order. We have the sun, which is the US dollar, then you have all the small planets, which are essentially, Canadian dollar, Aussie dollar, and so on and so forth. Jupiter would be euro, Saturn, pound, and then, yen, and so on and so forth. Well, how does this kind of tie in? Well, I said at the time that
what's Planet X?
That's a good question. I don't even know what that would be. I know some kind of maybe New Zealand dollar.
All right, buddy.
I don't mean to knock the Kiwis out there, but
they sure handled COVID pretty good.
Yeah, they did. I mean, it's nice being an island in the middle of nowhere. But at the last time I showed this in part one, I kind of made an off-the-cuff comment that, well, where's gold on this? Well, gold would actually be the Milky Way galaxy, because that's what everything is kind of rotating around. So I kind of wanted to bring that into the narrative now, and this is the Milky Way galaxy right here. And if you look, this kind of white dot area is roughly where we are, roughly speaking. And so, currencies are essentially rotating around what is ultimately, the universal peg, which is gold, which is right here at the center. And what I'm going to show, the chart I'm going to show next, kind of shows how all world currencies are now starting to move in correlation with gold in a way that it hasn't.
Same orbit.
Yeah, exactly. And so this chart is a weekly version of the other chart that I showed, the DXY US dollar index.
Yeah.
And for the longest time, this was essentially an inverse indicator of gold. I mean, when anytime it popped, gold would drop, and so on and so forth. And so the previous all-time high in 2011 was right here when the DXY was at 72. It consolidated, and then it broke out, and then multiple tests, and then it pulled back. Well, the next higher low of the DXY was a lower high on gold. That makes perfect sense, because as DXY goes high, dollar is higher, gold should in theory go down. And that was when had that kind of 1360 5-year resistance trend line period. This is where that happened. This is back in 2018. And then from there, gold popped up, and then DXY popped up, and gold started to trail back down to 1162 or 1163, which was the recent low. And then everything was starting to line up. Then all of a sudden, after we spoke in August last year, something happened. The actual gold actually basically hitched itself onto the treasury train and started trading lockstep with US Treasuries. And once that happened, it completely started to break the long-term DXY gold inverse relationship in a way that it hasn't in a very long time. And to me, that's a signal of gold starting to reassert itself within the global monetary order. Because if you look here on the recent spike, gold popped up to roughly, it's at 1730 now. But even when it had a huge spike, the DXY spike to 103, well, gold only bottomed at 1480 roughly. It was in the high 1400s. That doesn't make any sense. If this chart were to be on a one-to-one basis, relationship accurate, that would not have been possible. And yet here we are, the DXY is roughly at 100, and we're back up to 17 and 30. So gold is now starting to kind of, as currencies are all global currencies in the basket are starting to drop, gold is now starting to reassert itself back, making it stronger. It's moving up relative to all currencies globally, because ultimately that's what that's what this this chart is signaling. Sorry, I apologize. Is that gold is now reasserting itself. It's becoming much stronger, and now all global currencies are being weakened. And I hypothesized last time in part 2 that ultimately the primary purpose of a global unified world currency is ultimately to create a two-tiered system. And that gold was going to actually increase significantly in value relative to all world currencies. And sure enough, up until recently, there was no signal of that, but late in fall, that crack finally started to form, and that's actually where we're at now. So, and keep in mind, if we have this kind of dollar consolidation thesis back into 95 into March of next year, that's only going to be even further supportive and bullish for gold. Because if gold's rising in a rising dollar environment, one can only imagine what's going to happen when it enters a consolidated pattern, a falling environment. So this is kind of also supporting the theory that gold is continuing to rise or ascend. And this is actually another really kind of one of my secret charts I never really showed before. This is the first time I'm showing it, but this is the gold DXY relationship. So this is gold versus all the basket currencies in the basket, to kind of get more of a global price of actual gold. And it's obviously done in a ratio form. But when gold previously peaked in 2011, the DXY, it was a ratio of 26 to 1.
Yeah.
And so for all those people that say that gold is extremely overvalued, well, if you look now, it's currently only at 18 to 1, even though it's knocking on its previous all-time highs. It's just around the corner of roughly 1920. So we're not that far. We're within shouting distance of it. And more importantly, if you look at the actual structure of this base, this consolidated base here, it's actually much healthier than previous ones, because you're getting a smooth moving arc upward on the upper Bollinger Band, and there's a lot of pressure is building on gold. It actually broke out from this bull channel. It's now starting to move higher. And even if you look at the stochastics here, well, we've never had a period where it actually sustained above the 80 line. So this is actually the most bullish on the last 12-year basis that gold has been. And if you look at the MACD, same thing. It's building this beautiful, smooth, accelerating arc where the gap continues to widen. To me, this signals that gold is nowhere near overvalued yet. It still has a lot to move to the upside.
What's your view on governments confiscating gold?
Because no personal individuals actually own any of it. It's not like it was in the after in 1930s and 40s. Yeah, I don't I just don't see that happening, because back then, people have to remember, banks weren't very safe, so everyone actually held a lot of their wealth in actual physical bullion or gold. No one's doing that now. Less than 0.1% of the population actually has any physical gold. So it's really not advantageous to do so. If anything, they would be more inclined to use gold as a weapon against crypto, because crypto is something that they don't actually have complete control over, at least not yet. So to me, the whole confiscation narrative, I know it's happened in the past, but to me, it was a different period. It was a different time. I don't think it's necessarily correlated to modern times.
Okay, thank
And
you.
plus, because of GLD and ETFs and other structures
Yeah.
like that, there's really no point. I mean, anyone can just go, and that to them, that's still a financial instrument. So I don't think it's really going to be an issue. So if you want to
No,
buy
like
and hold it,
coffee cans buried in the backyard like 100 years ago, huh?
yeah, yeah,
Right.
exactly. And then if we kind of one more chart here is the gold to bond ratio, or gold to TLT. And if we look at the previous all-time high in 2011, it was at an all-time high ratio of 22-1. Well, ever since roughly 2015, gold and bonds have basically been lockstep in this very tight, narrow trading range. And so on a relative basis, gold is not overpriced to bonds, not even drastically. Now it's 10-1, whereas it used to be 22-1.
Interesting.
And so because gold is essentially trading in lockstep with treasuries, it's acting as a proxy of treasuries at the moment, of U.S. treasuries. But the difference is that gold. Dale, I'll ask you a question. What are the key differences between treasury bonds over gold? What is the benefit normally in a normal market?
Yield.
That would be yield is
Yield.
correct. Yield is one of them, and the other major difference, for those aren't aware, how
Storage.
well, liquidity is another one, but the big difference is that treasury bonds have a maximum par value of $1,000. So, for those that aren't aware how treasuries actually work, you buy a 10-year bond for $980, and over 10 years it appreciates from 980 to 1,000. That's a 2% yield because it went up $20.
Right.
So
Unlimited in gold.
correct. So so if you have no yield right now, which both gold and treasuries have none, and gold is capped at 1,000 par value, whereas bonds, treasury bonds, but gold has an infinite upside. I hypothesize that a significant portion of treasury demand is actually going to overflow into gold, and that's also going to help further ramp it up to the upside because.
Okay, I'm getting a question, segue,
Sure,
a great
sure.
segue on that.
Sure.
Do you have a price target for gold in March?
Yes, I do.
2021?
So by December 31st, 2021, I expect gold to exceed 2,100. My actual target's higher than that, but that's just kind of a general target. I do think actually
you don't want to say 5K, do you?
Well, I actually don't think gold will exceed 2,500 until there's a global reserve currency officially established.
Okay.
So 2,500 has always been kind of my cap on that. But if you go, hypothetically speaking, I'm not saying this is a target, but if you were to, this ratio used to be an accurate calculator because you used to be able to basically take the ratio, multiply by what you thought DXY would be at, and you would get an ultimate gold price target. So if we
saying, okay, go ahead. I'm sorry.
Go ahead. So what happened? So if we were to do a peak of 26, and you would multiply that by, say, hypothetically, whatever DXY of in the 90s, you'd come out with 2,444. So you can use this ratio, but I'm not necessarily saying that's a target. I'm just saying, but to me, I think within the next 12 months, you will see over 2,000 for sure by March of next year. Sorry, May of next year, which also ties into that March 2021 consolidation thesis. So at some point, gold will kind of peak in that area, and then I think it could even be higher than 2,000. It could be 2,100. My personal target is more in the 22 handle, to be honest.
Okay.
But I think by December 31st, 2021, we should be over 2,100.
Someone's making the case that bonds have infinite value if rates go negative.
So I'm glad you brought up NIRP. Negative interest rates is, in theory, you are correct. Bonds can go above a par value of 1,000 under negative interest rates. Obviously, a lot of European debt did that. But as a part of my thesis last time, I hypothesized that the Fed would actually choose not to go negative. And the reason is negative never worked in Japan. It never worked in Europe. So now we have multiple case basis where it just didn't work. So for them to use that, unless it was an absolute last resort, I view it highly unlikely. And more importantly, if the gold is supposed to be the foundation, if the US dollar is supposed to be the foundation of the global reserve currency, by definition, it would have to be roughly higher, a little bit higher, or more attractive, appealing for other sovereigns to kind of tie on to. So I think by definition, it has to stay a little bit in a better valuation range versus Eurobonds.
Okay, I can't let a thinker like you go, Alex, without asking you how this COVID-19 is going to play out. 100 years ago, people thought it was over on Armistice Day, and they went out and reopened their society, and there was a big second wave. You have any view on what's going to happen here?
Yeah, so if you actually look, I mean, you can see some kind of antiquated charts they did back then, but there was basically an initial small spike. There was roughly a 4 to 6 month pause, and then you had a huge, massive secondary spike, which was roughly 2.5, 3 times of the original. Now, keep in mind that secondary wave happened in a period where it took you 2 weeks to get anywhere on a boat. So ironically enough, our globally integrated transportation system could potentially exactly, it accelerates that process even more so. A lot of people think it's just the flu, and I'm not going to take either side of that debate, but I have family friends who they've lost 4 people in their family from COVID, and they said it is not just the flu, it is a very serious disease. Many of them were young and healthy with no pre-existing conditions. So to me, this is the fact that we're kind of throwing caution to the wind here by opening up haphazardly, prematurely. I think almost in some ways will probably increases the likelihood of some sort of secondary wave happening, ironically enough. So, I mean, the more prudent thing would have been to have stayed closed longer, but obviously with election coming up, politicians...
You think it was an act of nature?
So if you actually look on the CDC website, I can't believe they still left it up, but they put out essentially an ad or a notice that they were looking for trainees in May of 2019 for the level 4 biolab in Wuhan. They were launching a new program, a bioweapons program, like a biohazard program, and it's still on the official CDC.gov website. And so they were actually seeking to launch this level 4 lab, they never had a level 4 lab before. This is the first time they've done it in China. And coincidentally, 3 months later, or 4 months later, we have a massive outbreak. I think what happened was the reason why China immediately shut down Wuhan and closed down 60 million people immediately was they knew something had leaked out. Now, I don't think it was intentional. I don't think it was an attack. I don't think any of this kind of conspiracy theories. I think it's just sheer incompetence and stupidity. Like they basically got arrogant and thought they started playing with a weapon they do not know how to control. And anyone that's done manufacturing in China, and I did in a previous lifetime, the quality control is terrible. I mean, it's just they have no understanding of quality control.
It sure speeds up the process of giving up our civil liberties, of being traced and surveilled and everything. So that's the kind of thing that makes
and I'm actually going to tie into that kind of here in a second, and I'll kind of explain here a little bit further, but I kind of want to get through this last part here. So ultimately, going back to gold is essentially reasserting itself into the monetary order, and in this process gold will become a key player in a post-senior currency world. And ultimately, I think their ultimate goal is to create a bipolar wealth world, and that's essentially what they're trying to do, because central banks, global elite, they store a lot of their wealth in actual gold. And by creating a 2-tier system, you can thus allow gold to appreciate virtually exponentially. Now, I'm not saying it's going to go exponential, but there's no upward limit, because right now, if gold were to spike, it would send a major bearish signal to the dollar and it would cause all kinds of chaos. Whereas if everyone is on a singular currency and gold goes to the moon, it's just treated like any other asset class. Yeah. So to me, I think that's part of the ultimate goal. And moving forward, it's the other thing is that on a relative basis, there's never been a better fundamental backdrop for gold, because in the 1970s, we had 2 wars that we had to pay for, and we had to kind of monetize the war debts, and that created a huge inflationary wave in the 70s that caused the initial massive ramp of gold all the way from whatever it was, 35 an ounce to 800 roughly. So although we're not actually in war, to me in many ways Corona is like a war footing, because the amount of money we're printing is even larger than anything we've ever printed for any war before. So to me, that kind of ties into the narrative that, gold is kind of moving into kind of a post-corona world, or if I post-unified world, and currency-wise, it's going to increase in importance. And then tying corona back into it, I will in a second. But in conclusion, you know, the global forex parity thesis is starting to actually play out. You know, right now we're in that kind of consolidation period. And last time I hypothesized that parity window was between April 2019 and March 2025. Well, if you take the median of those two numbers, the halfway point is roughly March 2022. To me, that would be a logical target, or roughly a high probability period target for that period to happen. And then right now we're seeing cyan consolidation into March 2021.
What's the definition of cyan?
It's just the color on my chart. Just you know, that little period, that like big circle. I don't know what else to call it, so that's just what I call it.
Okay.
But it's this kind of consolidation period. And you know how we said it was going to kind of consolidate into March 2021. If the pattern repeats identically the same as last time, that's when it will happen. So that's it. And based on what we're kind of seeing, it kind of ties into one another. And then ultimately, gold is still very cheap on a historical relative basis compared to bonds, you know, DXY, and so on and so forth. And ultimately create essentially a two-tiered world wealth system of SDRs, of which everything else is based off of, and then ultimately gold. So that's kind of the narrative. But going back to the corona, to me, there is a dangerous precedent being set here from a kind of global monetary system standpoint. A global kind of political infrastructures that never before in human history have the global elites had so much power in such a short period of time. Yeah. And I'm very suspect they're going to want it, once they've tasted that fruit, that they're going to want to just give it away. I don't see how that's possible. Furthermore, they really don't like the current president at all. I mean, in many ways, they view him as a fluke, as an accident, or kind of a monkey wrench in all their plans. So I would be shocked if we don't see some sort of secondary reaction, or, you know, rhetoric popping up between now and the election. Obviously, China has recently re-entered the argument, or the narrative, that, you know, there's another potential friction, you know, geopolitical friction, or potentially trade war consequences of this.
So kind of see the possibility of the Cold War between China and the U.S. turning into a hot war. I mean, we're selling arms to Taiwan, we're delisting stocks, we're putting companies on blacklists, we're accusing them of the virus. Could this, you know, did you ever hear my poem about Corona?
No, I didn't. No, I didn't read it.
Corona, Corona, fear that I'll own ya. Born in a lab in China, spreading so I'll find ya. No one is safe, not even a king, and it will be the excuse for everything.
I mean, it is definitely being a very convenient backdrop. I mean,
yeah,
like I went back to the debt portion of the discussion. You know, they're literally trying to create exponential debt in order to justify, you know, forcing everyone to essentially adopt a new special drawing right. And so that's the way special drawing rights are constructed, is to essentially be a supernatural form of debt, so that once they own you based on debt, then they kind of
slavery
basically is what it is. Yeah, it's financial slavery. So
bondage. Debt is bondage. So this is what you do.
Yes, correct.
All the market you cover. And do you have a website now where
yes, I do. So initially, when I started Charts Coach, it was originally just designed to be, you know, kind of like educational technical analysis platform. But I mean, there was kind of grown exponentially since, and it's kind of grown into actually a kind of financial market content platform. So, you know, I do a lot of different macro articles. A lot of the stuff I do here for currencies, I also do for like geopolitical. And this is some of the recent articles I did. I did a 30-page article on crude oil. It discusses, you know, the history of oil, Middle Eastern governments and how sovereign crises they're in, potential fracturing of OPEC. It goes into, for those that have studied Matthew Simmons, it kind of discusses peak oil extraction. It just explains the friction between Russia and Saudi and the U.S. And then it was so popular, people requested a second one, so I did a second one called Twilight in the Oil Patch. It was a 15-page article, and it kind of tied in Texas Railroad Commission, and kind of discussed long-term peak, post-peak technical targets for oil. So if you want to look at those, you can do. I also discussed like a lot of job reports, you know, key sectors that are going to be impacted by 30+ million jobs. Real estate, subprime auto, consumer debt, and et cetera. And then, future upcoming reports. I'm going to have a kind of an addendum to today's webinar with 4K resolution charts coming out next week, and kind of goes more in depth with a lot of things we discussed today. Obviously, I didn't want to take up too much time. And then I'm going to do a 50-year macro analysis of gold, kind of tying in a lot of the things, the motifs we talked about today.
Where'd you get that picture of me standing in front of the bank? Anyway, Alex, another great presentation by Trading Warrior
Thank
Brothers.
you. And I appreciate it.
So Twitter, we know this is your Twitter handle. Do you have a
Correct.
website address?
Yes, that's it. Chartscoach.com, charts plural.
Okay.
So chartscoach.com, and then you gain access to everything's all inclusive. It's basically just basically give it away at cost just for educational purposes. But I mean, we do a lot of macro analysis and kind of just more geopolitical, all those kinds of fun things to discuss, and kind of more on a bird's eye view of the global economy and whatnot. So
thanks for sharing another insightful interview with us today, Alex. I appreciate it.
Yeah, I really appreciate it. Thank you so much. Obviously, stay safe and happy, and hopefully, God willing, you stay out of trouble and kind of avoid a lot of this chaos.
All right, buddy. Well, that's a wrap, everyone. Again, you can follow Alex at Mystery Trader 99 and www.chartscoach.com. So from one coach to another, may our words and what we teach create people being independent of us and anyone else.
God
That's
willing.
my hope.
God willing. Buddy. Mine too. Take care, brother.
All right, man. Okay, everyone, that's a wrap. Hope you enjoyed it. It'll be out on video soon. And we'll see you for Turnaround Wednesday tomorrow. You're very welcome, guys. Adios.